The maximum penalty for obtaining consumer information insurance under false pretenses is $5,000 and 1 year of imprisonment. The 1999 Service Moderation Act, the Glass-Steagall Act of 1933 was banned common ownership of bank insurance companies and security firms and erected a regulatory wall between banks and non-financial companies. Came under repeated attack in the 1980s. In 1999, Congress passed Financial Service Moderation Act, which repealed the Glass-Steagall Act. Under this new legislation, commercial banks, investment banks, retail brokerage, and insurance companies can now enter each other's line of business. The chronological city reflects the roles the court and the federal government has played in regarding the insurance industry. Let's now take a look at how individual states regulate this business and how industrial practices self-regulate. Agents, marketing, and sales practices. Marketing and sales, selling financial products such as life insurance and annuities require a high level of professionalism and ethics. Every state requires its licensed producers to adhere to certain standards designated to protect consumers and promote suitable sales and applications of insurance products. Some of these standards are listed below. Selling to needs. The ethical agent determines the client's need and then determines which is the best suited to address those needs. The two principles of needed-based selling include: find the facts and educate the client. Suitable recommendations, products. The ethical agent assesses the correlation between recommendation products and the client's need and capability by asking and answering the following questions. What are the client's needs? What products can help meet those needs? Does the client understand the product and its provisions? Does the client have the capability financially and otherwise to maintain the product? Is this product in the client's best interest? Full and accurate disclosure. The ethical agent makes it practice to inform clients about all aspects of the products. Recommendations including benefits and limitations. There should never be an attempt to hide or discuss this nature or purpose of the product, nor the company being represented. Insurance products are highly effective financial planning tools. They should be presented clearly and completely and accurately. documentation. The technical agent documents each client meeting and transaction. The agent uses fact-finding forms and obtains the client's written agreement for the needs determined, the product recommended, and the decisions made. Some documentation is required by state law. Ethical agents know these laws and follow them precisely. Clients serve ethical agents and know that a sale does not mark the end of a relationship with a client, but the beginning. Routine follow-up calls are recommended to ensure that the client needs also are covered and products in place still are suitable. When clients contact their agent for service or information, these requests are given top priority. Compliments are handed promptly and fully. Buyer's Guide, a policy summary. To help ensure the prospective insurance buyer selects the most appropriate plan for their needs and to improve their understanding of basic product features, most states require agents to deliver a buyer's guide to consumers whenever they solicit insurance sales. These guides explain the various types of insurance products, including variable annuities, in a way that the average consumer can understand. In addition, a policy summary containing information about specific policies being recommended must be given to a potential buyer. It defines the agent, the insurer, the policy in each rider, and includes information about premiums, dividends, benefits, amounts, cash, surrenders, values, policy loan interest rates, and life insurance cost index of the specific policy being considered. Most states require that this be done before the applicant's initial premium is accepted. The policy summary is also contained cost index that helps the consumer evaluate the suitability of recommended product. The net payment cost comparison index gives the buyer an idea of the cost of the policy at some future point in time compared to the death benefit. The surrendered cost comparison index compared to the cost of the surrendering policy and withdrawing the cash value at some future time. Because all states are interested in protecting interests of the buying public, the actions of the individual soliciting insurance sales are strictly regulated. However, the law regarding insurance marketing and trade practices vary from state to state. As a result, it is very important that you examine and understand your state's laws. National Association of Insurance Commissioners. All state insurance commissioners are directors are members of the National Association of Insurance Commissioners, NAIC. The organization has committees that work regularly to examine various aspects of insurance industries and to recommend appropriate insurance laws and regulations. The NAIC has four broad objects: to encourage uniformity in state insurance and law regulation, to assist in the administration of law and regulation by promoting efficiency, to protect the interest in policyholders and consumers, to protect state regulation and insurance businesses. State Guarantee Association. All states have established Guarantees Fund or Guarantees Association to support insurers and to protect consumers if insurance becomes insolvent. Should an insurer be financially unable to pay its claims, the State Guarantees Association will step in and cover the consumer's unpaid claims. These states' associations are funded by insurance companies through assessments. SGA exists to protect consumers if an insurer becomes insolvent, and funds and are funded by insurance companies. Advertising code. A principal problem of the states in the past was regulating misleading insurance advertising and direct mail solicitation. Many states now subscribe to the advertising codes developed by the NAIC. The code specifies certain words and phrases that are considered misleading and are not to be used in advertising of any kind. Also required under this code is full disclosure of policy renewal, cancellation, and termination provisions. Under Unfair Trade Practice Act, most jurisdictions have also adopted the NAIC Unfair Trade Act practices. This act gives chief financial officers power to investigate insurance companies and producers, to issue and seize or desist orders and impose penalties. The act also gives officers the authority to seek a court injunction to restrain insurers from using any method believed to be unfair. Included in the context is unfair trade practices, misrepresentation or mispresentation, and false advertising, coercion and intimidation, unfair discrimination, and inadequate administration of claim settlement. Claim settlement practices. Claim settlement practices of insurers are regulated by state insurance departments. Do not call registry. The do not call registry allows consumers to include their phone numbers on the list to which solicitation calls cannot be made by telemarketers. Calls made on behalf of charities, political organizations, and surveys are exempt. The rating services, the financial services and stability of an insurance company are two vital important factors to potential insurance buyers and insurance companies. The primary purpose of a rate of service companies such as AM Best, Fitch Ratings, Standard & Poor, and Moody's is to determine the financial strength of the company being rated. Please click here to review chapter summary prior to exam. Best. AM Best, superior ability to meet ongoing obligation. Fitch Rating. Fitch Rating, a very strong, capable meeting policyholder and contract obligation. Standard & Poor, very strong financial characteristics. Moody's, good financial security.